You can look at what is appearing on the table. We are taking decision trees, that is advanced management accounting. A revision question from May 2017, question 1A. So try to read. The solution appears on the board. Look at the solution before I present the answers. You check that solution. Check your solution. You are told, you are given this information. The information appears there. Fraier Limited, an events management company, is considering whether to advertise an outdoor concert. The sale of tickets is dependent on the weather, as indicated below. Note 1. If the weather is poor, it is expected that 5,000 tickets will be sold without advertising. There is a 70% chance that the weather will be poor. Bullet 2. If the weather is good, it is expected that 10,000 tickets will be sold without advertising. There is a that percent chance that the weather will be good. Bullet 3. If the concert is advertised and the weather is poor, there is a 60% chance that advertising will stimulate further demand and ticket sales will increase to 7,000. Bullet 4. If the concert is advertised and the weather is good, there is a 25% chance that advertising will stimulate further demand and ticket sales will increase to 13,000. The profit expected before deducting the cost of advertising at different levels of ticket sales are as follows. You are given a number of tickets from 5,000 all the way to 13,000. Then profits, they appear there. The cost of advertising the concert is expected to be shillings 15 million. Required. Using a decision tree, advise the management of Raya Limited on whether the outdoor concert should be advertised. You are given 12 marks. So first, I think you should look at, just pause your video and you look at the question. Understand the question first, because I'll take the solution. I'll just give you the solution, because that is the most important thing. Try to understand the question first. I'll give you the solution very fast. Now, here, as you know, the decision trees you always start with. The decision trees we start with a node. The first node where you start. So the first node, as you can see, what I have done, we have advertise, and then the other part, don't advertise. Advertise, and then the other part, do not advertise. I think that is what you can see there. You are able to see that remember it is advanced management accounting for CPA. So mostly it is CPA, Kasneb. The CPA, Kasneb, Kenya Accountants and Secretaries, National Examination Board, May 2017, question 1A. Now you start with a node. Option 1, you can advertise. Option 2, don't advertise. Then from there, you can see poor weather or good weather. Probability of the weather being poor, 0.7. Probability of the weather being good, 0.3. Advertising, when weather is good, then the same, you repeat the same probabilities, 0.7 and 0.3. Now, then we continue this way. As you see here, let me analyze by reading the question again. I think you have gone through the question. The code Fryer Limited and Events, Fryer Limited and Events Management Company is considering whether to advertise an outdoor concert. The sale of tickets is dependent on the weather as indicated below. If the weather is poor, it is expected that 5,000 tickets will be sold without advertising. So you are saying if the weather is poor, it is expected that 5,000 tickets will be sold without advertising. So weather is poor, no advertising. So weather is poor, that stands for this now. Weather is poor, the weather is poor, no advertising. That's that part now. If the weather is poor, it is expected that 5,000 tickets will be sold without advertising. So we are saying 5,000 tickets will be sold. So if you follow that path, we are saying the weather is poor, no advertising, 5,000 tickets will be sold. So how much profit or loss will you get at this path now? Let me complete that path. Where 5,000 tickets are sold, how much profit are we likely to get? So the 5,000 tickets, we look at 5,000 tickets is the first item. Look at the first item where you are given number of tickets sold. 5,000, 6,000, 7,000, 8,000, going downwards. Look at number of tickets sold. So if you are saying we sell, if you look at that point number one, the bullet number one, if you can read bullet number one, if the weather is poor, it is expected that 5,000 tickets will be sold without advertising. There is a 70% chance that the weather will be poor. That is what I'm analyzing. So if you are selling 5,000 tickets, what is the profit? It is the first item. It is a loss. It will be negative 20,000. Now look at that part from the solution. Look at my solution. 5,000 have used what? 20,000 as a loss. So that is the path that you are going to follow. That's the path that you will follow in that case. So that is the path for that particular information. That is, if the weather is poor, if the weather is poor, it is expected that 5,000 tickets will be sold without advertising. Remember, we started by you can either advertise, don't advertise. So you don't advertise, the weather is poor, you sell 5,000 tickets, how much profit will you get out of that? In our case, we have seen it is a loss of 20,000. So what you do by the end of this illustration, you'll be taking joint probability times what? Either the profit or loss which appears there. That is why you can see here, you are taking joint probabilities times those profits appearing there. But now you are able to see where that information will take us to. Point number 2. If the weather is good, that is bullet number 2. If the weather is good, it is expected that 10,000 tickets will be sold without advertising. Now, let me remind you about this. I think you have seen the 7%. The 0.7 where it is coming from bullet number 1. What I have done, this one. If the weather is poor, it is expected that 5,000 tickets will be sold. This one, 5,000 tickets will be sold without advertising. There is a 70% chance that the weather will be poor. So 0.3, 70% chances that the weather will be poor. So obviously to make it 1%, it will be 0.3. So this is a 0.7, the weather being poor, 0.3, the weather being good. Okay, so bullet number 2. If the weather is good, It is expected that 10,000 tickets will be sold without advertising. Again, we are following this path. Don't advertise. The weather is good. Remember, the probability is 0.3. But we are selling how many? 10,000 tickets. That's bullet number 2. So bullet number 2, you are going to follow this path. Don't advertise. The weather is good. You are selling 10,000 units. Again, you look at 10,000 units. What is the profit or loss? You look at 10,000 units, you find the figure there is 90,000 as a profit. Now let me present bullet number 2. Just read bullet number 2. The second bullet is what I'm illustrating. Bullet number 2. Read bullet number 2. If the weather is good, it is expected that 10,000 tickets will be sold without advertising. There is a that percent chance that the weather will be good. I'm drawing my decision tree, my second path, how it will look like. Bullet number 2. If the weather is good, it is expected that 10,000 tickets will be sold without advertising. There is a that percent chance that the weather will be good. Okay. Then, because we are saying 10,000 tickets will be sold, you look at that table again. The table where you are given number of tickets sold and profits. We are looking at 10,000 tickets will be sold. That is what we are told in bullet number 2. We are selling 10,000. So look at 10,000 from number of tickets. When you sell 10,000 tickets, what is the profit? It is the fourth item from below. You get 90. Your profit is 90. If you sell 10,000 tickets, your profit is 90. So that is what I have. Okay, so just bring your 90 here. My 90 is there. So by the end of my calculations, I'll be taking joint probabilities times 90. 0.3 times 90. Okay, we move on. So I'm through with this particular path. That part where there is no advertising. So this part, that part, there is no advertising. No advertising here. So if there is no advertising, the weather is poor, I'll sell 5,000 tickets and I'll make a loss of 20,000 shillings. If I don't advertise and the weather is good, I'll sell 10,000 tickets, I'll make a profit of 90,000 shillings. So that was bullet number 2. Now let me illustrate bullet number 3. If the concert is advertised and the weather is good, I'm now coming to this one now, where there is advertising. So this one shows what will happen if there is no advertising. What will happen if there is no advertising? By the end of the day, how much profit or loss will I make? So I go to bullet number. So bullet number 4, number 3 and 4, bullet number 3 and 4, they are helping us to understand what would be the performance of our business when we advertise and the weather is poor or is good. So let's move on. If the concert is advertised, that is bullet number 4. If the concert is advertised, and the weather is poor, and so advertised, and the weather is poor, if the concert is advertised and the weather is poor, there is a 60% chance. There is a 60. Remember here already you have 0.7 and 0.3 as they appear here. So that the 60% is not appearing here. These are for the weather conditions. The weather can either be poor or good. We said the probability of the weather being poor is 0.7 and that of being good is 0.3. The same here. So that 60% is going to the next part. If the concert is advertised, and the weather is poor, and so advertised, and the weather is poor, There is a 60% chance that advertising will stimulate further demand and ticket sales will increase to 7,000. So here, out of this node here, you have to extend those two branches there. And we are told that if the concert is advertised, and the weather is poor, so out of this, what is likely to happen out of that? If the concert is advertised and the weather is poor, there is a 60% chance that advertising, so I can take this one as 0.6 or 60% chance that advertising will stimulate further demand and ticket sales will increase to 7,000. So I use 7,000 there. My 7,000 is tickets I'll sell. So meaning I advertise, the weather is poor, 60% or 0.6 chance that sales will increase by 7,000. So I look at 7,000 tickets, what would be my profit or loss? I'll find it to be that 5,000. I'll present that. Now note, when I come here, 0.6, what is remaining to make it 1? 0.4. So there, this one is increase. Chances of increase 0.6. So obviously, the remaining percentage to make it 1% is 0.4 to make it 1, and obviously it is the opposite. In other words, these are what you call mutually exclusive events. So chances of sales increasing 0.6. So the other branch will be chances of the sales not increasing, and we are saying 0.4. Now the question is, where are you getting 5,000 from? So the 5,000 from is simply this 5,000 here, because it is when the weather is poor. When the weather is poor and there is no increase. The weather is poor and there is no increase. So 0.4 and 5,000. So you looked at 5,000 and then how much profit or loss? This 5,000 here, from that table given there, you find it is a loss of 20,000, which is the same as what we had here, 20,000. So let's present bullet number 3. The bullet number 3. What's that bullet? Number 3. You see it. If the concert is advertised and the weather is poor, there is a 60% chance that advertising will stimulate further demand and ticket sales will increase to 7,000. So bullet number 3. Check bullet number 3. If the concert is advertised and the weather is poor, there is a 60% chance that advertising will stimulate further demand and ticket sales will increase to 7,000. So this is this part here. We advertise, the weather is poor, 60% chances of increase to 7,000. You look at 7,000 tickets, we have a profit of that 5,000. So increase, the remaining part up there is no increase. And if there is no increase and the weather is poor, we are talking about 5,000, which means a loss of 20,000. So you look at these 7,000 tickets, what's the profit or loss? Look at your table. The table is given down, where you have number of tickets sold and profits. Established is 7,000 is a third item from the top. We have 5,000, 6,000, 7,000. So that is 35,000. You can see where this 35,000, this 35,000 is coming from. That one. Then 5,000, loss of 20,000. So that is that. Go to the last bullet, bullet number 4. If the concert is advertised and the weather is good, there is a 25% chance that advertising will stimulate further demand and ticket sales will increase to 13,000, right? If the concert is advertised, we are still on this path. If the concert is advertised and the weather is good, so you not go up there. That is when the weather is poor. We are saying advertised and the weather is good, so you follow this one. And the weather is good. If the concert is advertised, and the weather is good, there is a 25% chance. So you are coming here. You don't consider here because these are to do with the weather conditions, either good or poor. If the concert is advertised and the weather is good, there is a 25% chance that advertising will stimulate further demand and ticket sales will increase by 35,000. So increase. So when you branch, you move from this node, there are two options. Sales can either increase or no increase. The chances of these sales increasing is 25%, the same as 0.25. The remaining, so if this is chances of increasing, sales increasing by 13,000, then the chances of no increase is 0.75 to make it 1%. Now, if there is no increase in sales, then how many units are you supposed to sell? That is, the weather is good and there is no increase. You just pick what you have here. No increase in sales when the weather is good. The weather is good, and so you are picking basically the 10. That is where this 10 is coming from. No increase. So the first one, there is increase of 13,000. This one has been given 13,000. Probability of 0.25. What is remaining to make it 1 is 0.75. In other words, 1 minus 0.75, 0.75. But where is 10,000 coming from? Already you are given 13,000. The 10,000 is just this one. When the weather is good, there is advertising, there is no increase. And then you read those figures. Okay, so the last bullet, you have the last bullet there. Read for yourself that if the concert is advertised and the weather is good, there is a 25% chance that advertising will stimulate further demand and ticket sales will increase to 13,000. So if you look at 13,000 tickets, how much profit? It's 150,000. It's the last item. Look at number of tickets sold and then the profit. 13,000 tickets gives us a profit of 150,000. Then the other, we have explained the 10,000 tickets. You look at 10,000 tickets, how much is the profit? 10,000 tickets, it's 90,000. 90,000. So we are through with our decision tree. So our decision tree will be something like that. That is what we'll be having in our decision tree. So we just need that column for profit: 5,000 tickets, 7,000 tickets, 10,000 tickets, 13,000 tickets, and then after that, you multiply by probabilities. So the first, if I follow this pad here, I'll take 0.7 times 0.4, 0.7 times 0.4 times the profit now, times the profit, and I'll get a loss of 5,600. The second part, 0.3, and I'll take 0.7 times 0.6 times 35,000. 0.7 times 0.6 times that 5,000, I'll get a profit of 14,700. Then I'll take the third path, which is this one: 0.3 times 0.75 times 90,000. You get 20,000 to 50. The third part, so we have to the third part. The fourth part, 0.25 times 0.3 times 50,000. So this 0.3 times 0.25 times 150,000, you get that figure. So up to here, up to that, that is to do with when we advertise. So what is the expected monetary value when we advertise? What is the total expected monetary value when we advertise? So sum up those. So the figures are here. You sum up those 4 items up to them. This is a negative, it was a loss. 5,600 plus negative plus 14,700 plus 20,000 to 50 plus 11,000 to 50, you get 40,600. Then, what is the expected monetary value if you don't advertise? You just take 0.7 times negative 20,000 and you get negative 14,000. Then the other part, 0.3 times 90,000, we got 27,000. So you sum up the two together, negative 14,000 plus 27,000, you are getting expected monetary value of 13,000. So because when you advertise, the expected monetary value is 40,600. We less what? The expected monetary value of not advertising, which is 13,000. So the difference gives us 27,600. 27,600. And then you are told that the cost of advertising the concert is expected to be shillings 15,000. 15,000 or 15 million. The last item is given. The cost of advertising, the last line after the table. The cost of advertising the concert is expected to be shillings what? 15 million. The last item there. So what decision can you make out of that? What decision will you make out of that? So you are comparing with 15 million. So you should advertise because the 27,600,000 is more than 15 million. It's more than the cost of advertising. It's more than the cost of advertising. So that is the end of that. Numbers are here: 07, 27, 87, 10, and 3. So that is it for that. So you can follow what we have done. If you have any question, then you can contact me from that number. Right.